Welcome to BT Podcasts. In this episode, find out how to make the most of the small cap market for the remainder of the financial year. This episode is brought to you by RHB Singapore.
As we approach the halfway mark of 2025, investors are keen to uncover the promising opportunities that lie ahead in the small cap market for the remainder of the year, especially since Singapore's GDP has been forecast at 2% with downside risk. Which sectors hold the most potential, and how can investors get in on the action to shore up their portfolios during these volatile times? To shed light on these questions, we turn to RHB's Singapore Small Cap Jewels in 2025, which identifies small cap stock picks worthy of consideration. Welcome to BT Podcast by The Business Times. I'm Howie Lim, and joining us today with his insights, Alfie Yeo, Head of Small Mid-Cap Research at RHB Singapore. Alfie, welcome back. Our once-a-year chats are always fun.
Yes, thank you. Thanks for having me.
So I understand extensive research has gone into curating this list of top 20 small cap companies in Singapore. But before we get into it, how has the small cap market been performing so far? Also, we have to head back in time a bit. How did the ones that featured in 2024's Singapore Small Cap Jewels fare?
Okay, for year-to-date, the small cap index is pretty flat. Compared to the STI, it's up by about 2.7%, but that's just year-to-date. If we look at over a longer period since our picks last year, the small cap index has performed like 5%, whereas the STI index has done about 17%. But fortunately, our picks have outperformed. We did about 20%.
What do you think were the key factors, though, driving that outperformance of stocks that you highlighted in 2024, Alfie?
Well, I think a lot is based on our bottom-up picks, which we did last year. Some of the key performers included Centurion, which went up by about 120%. And then we have Econ Healthcare, which went up by 81%. There's a privatization deal going on. We also identified Dynamac, which went up 73%, and RENS, which runs Ichiban Boshi. They had a privatization deal as well, so it was up 36%. So thanks to all these privatization deals, we were able to get good upside from some of our top performers. But of course, talking about stock picks, there will always be stocks that underperform. So we recommended one called A-Stack. Most of their sales are based on Amazon, which is their key customer. And what happened with a stock with a high customer concentration risk is that when the customer pulls out their order, most of the company's demand for their products gets affected. So for A-Stack, it was down 46%.
Yikes!
But the long and short of it is that we have got stocks that perform 100%, 80%, 36%, 73%. So as a portfolio as a whole, we did about 20% and we outperformed the STI index. So,
nice.
Yeah. So it's about picking the right stocks and making more good picks than poor picks.
How do you do that? Because there's obviously criteria you have to look at. What sort of criteria did you use to select the stock picks this year?
We always use a top-down and a bottom-up approach. So for this year, we look at a few themes to formulate our top-down approach. Of course, the first theme on everybody's mind is the Trump tariffs.
Yeah.
The international tariffs. It actually created a lot of uncertainty to international trade in the market. So bearing in mind this key theme, we would want to avoid stocks that are highly exposed to international trade, especially sales to the US, with lots of exports to the US, because once the tariff hits, right, you might get a demand impact. So we want to avoid that. So one of the few things we did in terms of a top-down approach is to pick the construction sector, which is very domestically driven and has no exposure to international trade. The other sector is the pawn shops in Singapore. During times of economic uncertainty, you have a flight to safety, gold prices are up and they are beneficiary of gold prices. We have got a few stocks here, Hong Leong Asia, Pan United, BRC Asia. These are construction material suppliers, and also ISOTEAM, which does development, restoration projects and HDB estates. So these will be part of our construction sector picks. And moving on to the pawn shops, we have 3 listed pawn shops, Aspire Lifestyle, Moneymax Financial and ValueMax.
Do these sectors face any risk going forward, though? Because there are certain market conditions that favor them. If those market conditions change, then how?
Firstly, the pawnbroking stocks are positively correlated to gold price. And when gold price rises, they are key beneficiary because all their gold holdings are worth
Much more.
Automatically worth much more. So during this time, we spotted a theme that is global uncertainty around international trade. So being more domestically and more caution is going to support the gold price, which will benefit these companies. But of course, if the reverse happens, that forms the risk of these companies. So when the gold price falls, the value of the gold holdings of these companies will fall. So there is a risk.
Still to come, we've talked about RHB's criteria in picking these promising stocks. What's the outlook in small cap for the rest of the year? We find out in a moment with Alfie Yeo from RHB.
And now back to BT Podcast, brought to you by RHB Singapore.
We're speaking to Alfie Yeo from RHB. Earlier, you highlighted the pawn shop sector and also the risks it might face. You also talked about the construction sector. Are there risks that might face going forward?
For the construction sector, the risk is always the pace of projects. You can have a good pipeline, which is very positive. We have a very good pipeline of projects in Singapore, Terminal 5, MRT projects, hospitals, institutions. All these are part of the government plans to build up our infrastructure.
So all of that factored into your selections, right?
Yes, and because part of it is due to the Trump tariffs, and one of the drivers of economic growth is that the government come in to spend. And when the government comes in to spend, it may shore up our GDP growth. And due to that, we are positive on this sector. And of course, the risk, if you're talking about risk, is that while the project pipeline is there, the BCA forecasts about 47 to around 53 billion in projects this year. So it's a healthy value of construction projects to be carried out. But while the pipeline is strong, these projects must carry on constructing and being in execution. Like for instance, during COVID, everything comes to a halt and stand still. While you have these projects in the pipeline, the risk is that you cannot recognize these projects because they are not under construction. There's no activity. So that's an extreme case, but in case of a slowdown in building activities, revenue recognition will be slower. So that will be the risk.
Yeah.
But having said that, the outlook is pretty clear that we have a strong pipeline of projects that is going on in the next few years.
How do you formulate, though, Alfie, your bottom-up stock picks for this particular report?
So for bottom-up stock picks, we try to have a mix of a few sectors. Some of it will have good growth story, good dividend yield. Some of it will have good return on equity. Some of it might have attractive valuation. So the sectors that we have put together include healthcare, oil and gas, property, tech, and some of the industrial companies. So each of these, we look from a bottom-up perspective. So let's say we go into healthcare. We've identified Livingstone Healthcare. It's a company on a turnaround play. They've lost some doctors last year and therefore revenue came down. But going forward, they are going to build up their team of doctors, which will build up their revenue as well as their earnings. So this is a call in healthcare on earnings turnaround play. So in oil and gas, we have Marco Polo Marine. We are positive on their new CSOV vessel that's going to be deployed. Basically, this vessel helps to construct wind farms, and they are really in big shortage in the market. So they are able to command good rates and good utilization for this vessel, and which we think will help in terms of the outlook. Yeah, property, we have 3 stocks: Centurion, LHN, and Propnex, which is the property agent. For Centurion, they are facing a tight supply in foreign worker dormitory beds, and therefore they will benefit from renting out the beds, and the beds now have upward pricing pressure, where at every opportunity when they revise rates, going to benefit that. So that's for Centurion, and they do have a good yield as well. For LHN, there's potential for spin-off of their Collywood properties portfolio. They're also expanding their assets under management. So for Propnex, it's just exposed to the property market. For tech, we have 2 stocks. Basically, we just wanted to have a representation of tech stocks, but we have culled back to stocks which have limited exposure direct export exposure to the US. So for Grand Venture Tech and Franken, right, about 10% of direct exports are to the US. But then again, they are serving customers that have manufacturing facilities outside of the US, which the semiconductor, AI, chip growth will still be going on. So they will still benefit from that. And based on the Trump tariff, we still do not know if semiconductor chips to the US will stay exempted. The situation remains dynamic, but then again, these are the tech stocks we think have potential, but have very limited export exposure to the US. So industrials, we have 4 stocks: Oil Tech, Riverstone, GKE, and CSE. So for Oil Tech, they are riding on the expansion of plantations. They're building up capacity for refining edible oil. So we think that they're going to benefit from it. For Riverstone, we are hoping for second half semiconductor recovery. So more of their gloves manufacture will be used and there'll be more demand from there.
How challenging has it been to come up with the stock picks for this year? Because the tariff situation is so fluid. Suddenly it was 145% for China to export into the US. Now it's 30%. Who knows what will be come July when the pause is up? What do you think?
Yeah, so this is why we have deliberately avoided stocks that have direct exposure in this area. Like you can see from our picks, at max, we have only 2 tech companies represented, but even then, these tech companies have minimal direct exposure to the US. So we have used 2 teams, which is largely the construction sector and the local prompt broking sector. So these are pretty much domestic and pretty shielded from all the uncertainties that's happening globally.
What other sort of economic trends, financial conditions, so to speak, that might impact the small cap space beyond the Trump tariff policies? Give us some tips, how are we supposed to navigate if we're supposed to keep an eye on economic trends and financial conditions?
Okay, so I would say that the Trump tariffs are very dynamic and nobody knows what is going to happen. But we'll go along the lines on looking at what has better visibility and what is more certain. And this is what we have done with our stock picks, which is to focus a little bit more on the domestic sector, construction, for example, the pawn shops, for example. If you want to go beyond that, look for companies with exposure to maybe ASEAN without direct export exposure to the US, and also in products that necessitate, for example, like Sheng Siong is a very good example, but that's a large cap stock beyond our scope here. So I think I'll look at those that have more certain variables and will benefit from these trends.
I wish we had more time. Alfie Yeo, Head of Small Mid-Cap Research at RHB Singapore. Alfie, see you next year.
Thank you.
This has been BT Podcast by the Business Times. I'm Howie Lim.
This episode of BT Podcast was brought to you by RHB Singapore.
Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.